When an investor hands their capital to a portfolio management service, they delegate immense discretionary power. That transfer creates a specific vulnerability: information asymmetry. This is Chapter 12 of the NISM Series 21A workbook. It covers the regulatory, governance, and ethical aspects of portfolio managers. These regulations form an engineered, dual-layered risk architecture designed to constrain bad actors. The first layer is systemic integrity. These are macro-level laws that protect the broader financial market from a rogue firm. The second layer is fiduciary accountability. These are micro-level operational rules that protect the individual investor from the firm itself. We will deconstruct this architecture from the outside in, starting with the systemic macro laws and drilling down to the specific codes governing client distributors. Mastering this dual architecture is the technical requirement for any fiduciary professional. The first line of defense protecting the open market is the Prevention of Money Laundering Act of 2002. It stops illicit funds from entering the system. Operationally, PMLA requires portfolio managers to execute rigorous Know Your Client and client due diligence protocols before accepting capital. If a transaction looks suspicious, the firm must report it to the Financial Intelligence Unit of India within 7 working days. Once capital is legally inside the firm, the SEBI Prohibition of Insider Trading Regulations of 2015 take over. Inside a PMS, designated persons often possess unpublished price-sensitive information. Trading on that data affects market integrity. Regulations mandate a Chinese wall policy, isolating the dealing room so sensitive information flows strictly on a need-to-know basis. The compliance officer also maintains a restricted list. If a designated person attempts to clear a trade for a restricted stock, the system blocks it. For the Series 21A exam, you must identify the parameters of contra trades. A designated person cannot buy a stock and then execute a contra trade, meaning a sale of that same stock within 6 months. However, for mutual fund units, that restriction is 2 months. If they violate this lockup, the profits are disgorged to the SEBI Investor Protection and Education Fund. Finally, the SEBI Prohibition of Fraudulent and Unfair Trade Practices Regulations of 2003 explicitly ban manipulative tactics like front-running client orders. These 3 macro pillars ensure that a well-resourced PMS firm cannot be weaponized against the open market. The focus now shifts to micro-level operations governed by the SEBI Portfolio Managers Regulations of 2020, which constrain how the firm handles individual client capital. A firm must hold a SEBI certificate, maintain a specified net worth, and appoint a principal officer to hold ultimate legal responsibility. The central operational constraint involves the amount of risk a manager can take with unlisted securities. Discretionary portfolios are generally restricted to listed securities, money market instruments, and mutual funds. For these clients, the allowance for unlisted securities is 0%. Non-discretionary or advisory services are permitted to invest up to 25% of their assets under management in unlisted securities. Large value accredited investors can have up to 100% exposure, provided they receive appropriate disclosures. The regulations also apply a related party constraint to prevent internal conflicts of interest. A portfolio manager cannot invest client funds into the firm's own associate or group companies with explicit prior positive consent. Clients must have the option to dissent or to set hard percentage limits on these related party investments. To ensure visibility, the firm must furnish a detailed performance and expense report to the client at least once every 3 months. The 2020 regulations act as a hard boundary, limiting the risk a manager can take with a client's capital. The final node of the architecture is the interaction between the PMS distributor and the prospective client. Distributors must hold a valid NISM certification and obtain registration with APMI, the Association of Portfolio Managers in India, for industry oversight. The APMI Code of Conduct prohibits distributors from charging upfront fees, assuring returns, or basing recommendations solely on their commission structure. To remove complex jargon during a sale, SEBI requires the Most Important Terms and Conditions, or MITC document. This document highlights critical data points on a single page, including exit loads, exact fee structures, and the client's risk tolerance. Alongside the MITC, the firm must prominently display the SEBI-mandated investor charter on their website. The charter standardizes the timeline of basic services, clarifying exactly how long account openings, grievance redressals, and reporting should take. Mandatory APMI registration, the Code of Conduct, and the Investor Charter ensure that a client's entry into the PMS system is transparent. A portfolio management service is a high-risk engine of capital allocation that operates within a precise regulatory framework. This model starts with the client, protected by the Investor Charter and APMI Code of Conduct. Around them, SEBI's 2020 regulations enforce strict investment limits and reporting timelines. Finally, macro defenses like PMLA, insider trading, and PFUTP encase the firm, shielding the open market. This integrated architecture works to eliminate information asymmetry across the entire financial ecosystem. Understanding why these rules exist is what separates a salesperson from a professional fiduciary. In the world of portfolio management, trust is a product of